Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the latest weekly update on As Good as Gold. Over the past week, after hitting record highs, gold prices have entered a tug-of-war between bulls and bears. The Fed's rate cut path and ongoing geopolitical tensions are the driving forces behind the price swings. Meanwhile, strong demand from emerging markets and a steady inflow of funds into gold ETFs are also shaping the outlook for the fourth quarter. Traders are now keeping a close eye on Friday's non-farm payroll report, as it's expected to guide gold's next move. So in today's video, I'll start with a quick technical analysis, followed by a recap of the key factors that have influenced gold recently and also over the past 3 months. Then I'll wrap things up with a discussion on how the upcoming non-farm payroll report might impact prices. So let's dive in. Looking at the daily chart of gold against US dollar, we can see that prices initially surged following the FOMC meeting. Gold closed higher for 6 straight days, breaking above $2,600 and hitting an all-time high of $2,685 on September 26, with gains of up to 5% in the run. However, that momentum didn't really carry into the 7th day. Bears stepped in last Friday, wiping out a third of those gains in just 2 days. Since then, both bulls and bears have been taking turns, and this morning, the price was hovering around $2,660 without a clear trend. While if the bulls regain control, the reaction near the all-time high of $2,685 will be key to watch before a potential push towards $2,700. And on the downside, if the pullback deepens, previous resistance at $2,585 and the upper boundary of the August to September consolidation range around $2,530 may offer some support. While in the short term, I think there are 2 main factors influencing gold prices: the Fed's rate cut trajectory and geopolitical tensions. The 50 basis point front-loaded rate cut in September surprised the market, leading to a more dovish outlook, with 2-year U.S. Treasury yields dropping to 3.5%, their lowest since August 2022. Additionally, the FOMC projections raised the 2024 unemployment rate forecast to 4.4%, up from 4%, while inflation expectations eased. This has strengthened the market's belief in further rate cuts this year. And a slight dip in August core PCE and contractionary levels in September's ISM manufacturing PMI further reinforce this view. So lower opportunity costs of holding gold helped push prices to new highs. That said, Powell's recent hawkish tone hinted at a more patient approach to easing, dampening expectations for a 50 basis point cut at the November meeting. This shift, combined with some profit taking, put some pressure on prices earlier this week. But the pullback in gold has actually been relatively shallow, mainly due to escalating Middle East tensions. Given how poorly markets tend to price these risks, I believe any shift in rhetoric between the parties involved or, signs of U.S. involvement could significantly heighten volatility. Additionally, concerns about the potential negative impact of the ongoing U.S. port strike on the October payroll report are adding to the risk-off sentiment, further supporting gold prices. And now, looking at the bigger picture, over the past quarter, beyond the Fed's rate cut and the geopolitical issues, worsening U.S. deficits and high public debt, as well as strong gold purchases from emerging market central banks like India, have also played a major role in lifting gold. The inflow into gold ETFs, driven by rate cuts, has also been important. So in my view, these factors are likely to continue influencing gold's trajectory this quarter. In short, while gold is caught in a tug-of-war in the near term, with the broader direction of U.S. rate cuts unchanged, I do believe the downside risks for gold are limited, and I personally remain bullish on the metal. And for the rest of the week, Friday's US non-farm payroll report will be a major focus. The market expects 144,000 new jobs added, slightly higher than last month's 140K, with the unemployment rate holding steady at 4.2% and average hourly earnings growth slowing to 0.3% on monthly basis. Given the market's sensitivity to any negative surprises, I believe that if job growth falls below 100K, or specifically the unemployment rate rises above the Fed's 4.4% forecast, based on a 50 basis point rate cut in November will surge, potentially pushing gold past $2,700. Otherwise, gold is more likely to remain in a consolidation phase. So that's pretty much all for this week. If you have any ideas on how the upcoming non-farm payroll report might impact gold trading, drop a comment below and let's discuss. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!